Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us again here at AusBiz as we get across the market movements overnight. Oil prices having surged and equity markets falling as the conflict between the United States and Iran re-intensifies. The US has reinstated a naval blockade on Iranian ports in the latest escalation that has unnerved investors. On Wall Street, tech shares copped the brunt of the selling. Specifically, Micron fell heavily along with Nvidia, while US-listed shares of South Korean chipmaker SK Hynix sank after rising more than 12% in its Nasdaq debut on Friday. SanDisk, Marvell Technology and Intel, the other notable movers there. The shares of Elon Musk's SpaceX fell and then recovered after hitting their lowest level since the IPO. US energy majors tracked the rising price of oil, whereas US-listed shares of the gold miners followed the bullion price lower. And tomorrow, the major financial firms kick off second quarter earnings season led by Bank of America, Citigroup, Goldman, JP Morgan and Wells Fargo. And the world's first publicly listed nuclear fusion company, General Fusion, surged 38% in the first day of trading after merging with a special purpose acquisition company. Well, President Trump says the United States is reinstating its blockade of Iranian shipping in the Gulf and will ensure the Strait of Hormuz stays open for a fee following more missile and drone attacks. Posting on social media, he said the US will be, from this point forward, known as the guardian of the Hormuz Strait. But as such, and as a matter of fairness, he says, will be reimbursed at the rate of 20% on all cargo shipped. Well, US forces struck a submarine maintenance facility, while Iran claims to have targeted US military facilities in Bahrain and Kuwait and destroyed radar systems in Oman. Concern is now returning about the inflationary effects of rapidly rising oil prices, with US Fed member Christopher Wallace saying, if we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. So those concerns reflected on the Treasury market, US yields jumping, the US 2-year up to 4.28%, the 10-year at 4.62. Markets pricing in a 45% chance the Fed funds rate will be hiked by 25 basis points at the next meeting at the end of this month, a 100% chance of a hike by September. Australian 3-year government bond yield futures rose to 4.5%, the 10-year at 4.94. US dollar index up 0.5%. The Aussie dollar is currently trading at 69.2 US cents. Well, oil prices surged more than 9% to 1-month high after the US announced a naval blockade of Iran's coastline, ports and oil terminals, reigniting concerns over energy shipments through the Strait of Hormuz. Brent crude futures settling at $83 a barrel. Gold fell heavily on news of rising energy prices and inflation concerns. Spot gold at $4,000 an ounce. Copper futures little changed. Iron ore down to $100 a ton, and risk-off sentiment has pushed Bitcoin lower. It's trading below or around $62,000. Well, as US earnings season begins and key economic indicators roll in, investors are watching to see whether the fundamentals can keep pace with market expectations. Earlier, I caught up with Damian McIntyre, who's the senior portfolio manager at Federated Hermes.
The market has moved pretty strong, especially if you look at large cap growth or any of the US based indices. They've really moved off of the lows that we saw in late March into the close through, frankly, last week. They dipped a little bit on Monday, but overall they've been performing strong. And the reason for this is very strong earnings. We have had spectacular earnings season in the first quarter of this year. We're about to report the second quarter of this year. If you look at market expectations, in general, we are looking at about a 22% year-over-year growth in EPS for the second quarter. That would be the best quarter since the fourth quarter of 2021. So markets have rallied a lot in the United States. However, we feel this is very justified because the economy is going strong and earnings are following. That is really helping stock performance.
There has been some concern that's been very concentrated in terms of that market leadership, particularly from those AI leaders there. Are you seeing a broadening, if you like, of the performance on the broader market there?
It's easy to look at the performance of some of the tech names and think about how concentrated a lot of these rallies are. Tech earnings are certainly pulling the market higher. But if you look outside of tech into utilities, into consumer discretionary, and other aspects of the economy, we are starting to see a broadening out rally. What we are typically seeing is these tech companies are spending a lot, but say they build a data center, right? They have to get concrete, they have to have steel, they have to have carpenters and plumbers work. That makes its way into the broader economy. So while they are buying a lot of semiconductor chips and a lot of other electrical components, it's also going into industrial companies and utility companies and overall just consumer paychecks. So we are seeing that broadening out rally, and we anticipate it to continue into the second half of this year.
And how do you see the broader economic backdrop at the moment, and particularly how that's likely to influence earnings going forward, particularly given the risk that interest rates could rise? And of course, that is very much in focus at the moment, given the potential inflationary effects we're seeing out of the Middle East with rising oil prices.
I do not envy Kevin Warsh at all in trying to navigate this interest rate policy. It's really, a trial by fire for him as he takes the helm of the Federal Reserve here in the middle of the year. Overall, oil has just added a lot of volatility to what is going on with inflation, and it's really muddied the waters. In the first 2 months of the second quarter, we saw oil tremendously higher, and we saw CPI follow pace. And now we've seen crude and WTI fall back into the 70s. And frankly, that's much lower. That's a disinflationary pull. So for Kevin Warsh, who's trying to navigate what types of interest rate policy he should be doing in the United States, it's really confusing. And we think that the best path forward for Kevin Warsh is, frankly, to take his time, to listen to what markets are doing, and just overall stay paused for a while until we get a little bit of a better picture of what might be coming out of the war in Iran.
Yeah, well, Damian, as you mentioned, they're very difficult for central bankers at the moment, particularly given what is going on in the Middle East. What is your view of just how aware investors should be of those news developments out of the Middle East, given that really, I mean, we're back to the beginning, it would seem, as far as that conflict is concerned?
It seems like every single week we are either on again or off again with the war in Iran and the Strait of Hormuz. We thought we were getting a little bit of progress with the MOU, and now there's threats of strikes again and attacks throughout the two countries. But I like to look at what's going on with oil, and it hasn't reacted too much to yet. So perhaps this is a lot of saber rallying. It's a lot of negotiation. It wouldn't be the first time you saw President Trump get close to a deal and then pull back to try to get a little bit of better terms out of it. So overall, we are hopeful and optimistic that peace will eventually come in the Middle East. But certainly, listening to some of these headlines, they can be frightening at times. And we understand why some investors may have pause with what's going on in the Middle East.
Well, Damian, let's turn to positioning then. I see you're overweight equities. Why is that? What are you seeing in the market right now?
Our overweight in equities is really focused on the AI trade. There are a lot of people who are afraid of whether this might be a bubble, and we think it's more a broader, long-term economic expansion. Market investors are looking for about $700 billion worth of capex between the big five hyperscalers this year. And you're starting to hear rumors of upwards of $1 trillion in capex for the big five hyperscalers next year. As I mentioned before, this is something that really makes its way throughout the overall United States economy. It finds its way into consumer pocketbooks. We're getting retail sales later on this week for a barometer of how the consumer is doing. And for the first 5 months of this year, retail sales on the control group have grown by at least 0.5% month over month or better. So it's a very strong consumer that's out there right now. And overall, we think that's a pretty solid backdrop for the overall U.S. economy. And that gives us really good, comfort in our equity overweight.
Sorry, and I was just going to say also, beyond what you're seeing there on Wall Street, you're also seeing some value then in emerging markets?
Yes, emerging markets, you can't really, talk about the AI trade without talking about emerging markets, whether it's Korea with some of their, memory names out there, or Taiwan or China. Really, the AI backdrop flows through the emerging market index, and we feel very comfortable with that overweight, despite the pullback we've seen in the past couple of weeks. We think overall that is more of a technical trading. At times, stocks can feel a lot more like a voting booth than a weighing machine. But overall, as the AI economy continues to broaden out, it continues to grow throughout the world. We think this is a very good setup for the emerging markets equities.
So, Damian, do you want to be fully invested at the moment, or is it worthwhile having cash on the sidelines, do you think?
For most investors, we favor a balanced outlook approach, never going too far over your overall risk tolerance. That being said, with cash rates where they are right now, in the high threes in the United States, that's a very tempting proposition. And when you compare it to the zero interest rate policy we had through the 2010s, it's really nice to actually get interest and return on your cash investment. So overall, we would recommend keeping your cash at a typical neutral level and funding the equity overweight with an underweight in fixed income, where, despite the higher yields, there's a little bit of volatility going on with rates, with the uncertainty with inflation. And we just think the risk isn't really worth the reward as it is. So we fund our equity overweight with an underweight in fixed income and are generally neutral in cash.
Damian McIntyre from Federated Hermes. Let's now refocus on the local market. We're looking to start lower. S&P SPY futures there down close to 0.1%, reflecting that risk-off sentiment we've seen more globally off those developments in the Middle East. We'll across that and much more. Join us for the open.